Today, in a housing market where nearly half of buyers are paying over $2,600 a month for a typical mortgage, there's growing concern about when this market bubble might burst. Despite high interest rates and soaring home prices, people are losing faith in the market as evidenced by recent drops in demand. This market is unlike anything we've ever seen before, with simultaneously low demand and a severe shortage of homes for sale. While low demand might suggest lower prices, the tight supply keeps prices stable or even rising in some areas. This delicate balance makes the market vulnerable to a potential crash triggered by an unforeseen catalyst. The major crash everyone keeps hoping for isn't as far-fetched as many of the housing bulls make it out to be. To understand why, let's take a step back and look at some brand new data coming out of Mortgage Bankers of America. To get a complete picture in detail, keep watching the video till the end. I hope you all remember what happened in the 2008 market crash, often referred to as the Global Financial Crisis or GFC, which was one of the most severe economic downturns in modern history. It was triggered by the collapse of the subprime mortgage market in the United States, which had far-reaching consequences worldwide. The crisis led to a widespread banking and financial sector meltdown, resulting in a sharp contraction of credit markets and a global recession. Key consequences included massive job losses, home foreclosures, and a significant decline in housing and stock market values. Major financial institutions like Lehman Brothers faced bankruptcy, and governments around the world had to intervene with massive bailouts to stabilize the financial system. The crisis had a profound impact on individuals, businesses, and governments, leading to a loss of trust in financial institutions and triggering regulatory reforms. Let's break this down for you. Most people buy their homes with mortgages, right? Well, the demand for homes is directly connected to the number of people applying for mortgages. Lately though, we've been seeing a pretty significant drop in mortgage applications, like the lowest we've seen since 1995. And you know what? It's not really that surprising. There just aren't as many folks applying for mortgages, and the demand for homes has hit a historically low point. In fact, if you compare it to the peak back in late 2021, the demand has fallen by more than 50%. That's a pretty big drop. But here's the real kicker, the thing that's got experts worried. This situation is like setting the stage for a potential housing market crash. All it needs is a trigger, and that trigger could be an increase in the number of homes available for sale. You see, right now, there are very few houses on the market, so even a small uptick in the number of listings can lead to some serious price swings across the entire country. It's like a house of cards waiting to tumble. And to make things even more precarious, the housing market kind of follows this principle known as the law of the vital few, or the principle of factor sparsity. In simpler terms, it means that a housing market crash can happen really quickly in a situation like this. To put it in simpler terms, the value of your home is largely determined by the few sales that happen in your neighborhood throughout the year. Now, let's put it in perspective. Before 2020, we were looking at 2 to 3 times more home sales than what we're seeing now. In fact, it's entirely possible that in the last year, only a handful of homes have been sold in your neighborhood since the beginning of 2023. It's kind of mind-boggling when you think about it. In a nutshell, fewer mortgage applications and low housing demand are putting the housing market at risk. The scarcity of homes for sale means even a small change can trigger significant price fluctuations and potentially lead to a rapid market crash. Your home's value hinges on a few sales in your neighborhood. Now, before we go to our next point, please just take 2 seconds and hit that like and subscribe button if you're enjoying the video thus far. Each like is a massive boost to the channel, as it provides instant feedback for the algorithm to push the video. Imagine you live in a typical suburban neighborhood. You've seen houses being bought and sold, and you may have wondered how those transactions affect the value of your own home and the homes around you. Well, it turns out that just a few home sales can have a significant impact on the pricing of an entire neighborhood. To put it simply, the sale price of as few as 3 houses can influence the prices of up to 300 homes in your vicinity. This might sound surprising, but it's a reality in the world of real estate. This ripple effect doesn't stop at the neighborhood level. It extends to the entire city and even the broader real estate market. In essence, these few transactions have the power to reprice a substantial number of properties. The result is that very few transactions can dictate price levels for an entire city or region. This phenomenon is a key reason why the Case-Shiller Index, an indicator tracking home prices across the United States, can exhibit significant fluctuations in relatively short periods, sometimes lasting less than 3 years. In a dynamic real estate market, just as prices can quickly surge, they can also plummet, especially in a market with low liquidity and when demand is at or near record lows. Even a small increase in the number of homes available for sale can have a profound impact on the overall market. Now that we understand how sensitive the housing market can be to even a handful of transactions, let's explore what might trigger a market crash. In past real estate market crashes, including the infamous 2008 financial crisis, one common element was investor capitulation. This term essentially means that when investors face significant losses, they tend to be the first to sell their properties. This is because they have a strong financial incentive to limit their losses. In contrast, regular homeowners, even if they bought their homes at inflated prices, often fight tooth and nail to hold on to their primary residences because they have more at stake. So, if a housing market crash were to start, it would likely begin with investors deciding to offload their properties. The question is how and where this would occur. Recent reports from sources like Redfin indicate that investor activity in the real estate market is decreasing. One of the major factors behind this decline is rising interest rates, which have become a significant hurdle for investors. Many real estate investors rely on borrowed money or operate on margin, and with slower price growth and increasing interest rates, the profit potential in real estate has dwindled. In the past, the biggest cities where investors were active have often turned out to be risky areas for a housing market bubble. Examples of such cities include Las Vegas, Phoenix, and Miami. Interestingly, these were also the places where the last major housing market crash began, and they were hit the hardest by the crash, leading to substantial losses after 2008. Today, we're seeing a similar pattern repeating itself. At one point last year, investors were buying nearly a third of all homes in Phoenix. In some neighborhoods, it's estimated that as many as half of the homes were purchased by investors. This kind of intense investor activity can create an environment where the conditions for a market crash can quickly escalate. Going back to the principle I mentioned earlier, in neighborhoods with heavy investor involvement, as soon as one investor senses trouble or uncertainty, a fire sale mentality can take hold. In this scenario, a few dozen houses changing hands can trigger a chain reaction that resets property values for the entire city. This domino effect can also spill over into other metropolitan areas across the United States. To find evidence of this, you don't need to look any further than what happened in Las Vegas after the 2008 crash. Between 2006 and 2012, home prices there plummeted by a staggering 62%. This kind of panic and price collapse doesn't occur without speculative behavior and excessive greed from investors. Prices can drop rapidly, just as they had surged before. During a particularly intense phase of this crash, it seemed like home prices were on a freefall. From October 2007 to October 2008, the average price of a home in Vegas dropped by 28%, and in some fashionable neighborhoods, the losses were even more significant. It wasn't uncommon to see a Vegas home that had been selling for $300,000 one year suddenly worth $150,000 the next year. The market essentially disintegrated overnight, with investors playing a significant role in driving prices to unsustainable heights during the mania. The consequences were devastating, as illustrated by this chart. It took Vegas over 15 years to recover past its peak prices from 2006. For many people involved in real estate, this meant substantial financial losses. Are we prepared for such an economic fallout? Can we learn from the mistakes of 2008? Share your thoughts in the comments. And if you found this video insightful, don't forget to subscribe, like, and hit the notification bell to stay informed on this critical issue. Thank you for watching.